stop what you're doing. If you own or are even thinking about buying Vera Therapeutics, ticker symbol VERA, you need to hear this 5-model valuation breakdown right now. We are looking at a biotech company with absolutely zero revenue. Zilch. They are burning through massive amounts of cash every single quarter, yet Wall Street is somehow stamping this stock with a strong buy rating and predicting a nearly 200% upside. I mean, how is that mathematically possible? Is the market completely delusional, just blindly chasing the next big unicorn? Or is there some hidden fundamental truth here that retail investors are totally missing? Let's dive right into this explainer and find out. So, last week, I ran Vera through 5 strict valuation models and 2 legendary investor checklists. And honestly, what I found completely shocked me. When you just look at the raw data, this stock defies almost every rule of traditional investing. But we need to look closer. By the end of this explainer, you'll know definitively if Vera is a hidden Warren Buffett buy or a massive, wealth-destroying Peter Lynch track.
You see, investing in clinical-stage biotech isn't traditional investing. It is literally like playing high-stakes Texas Hold'em, and the FDA is the dealer. We all know that ultimate retail investor nightmare, right? You buy into the hype, a critical clinical trial fails, and boom, your entire portfolio gets wiped out overnight. That perfectly illustrates the exact gamble we are looking at with Vera Therapeutics. It's a high-stakes bet on one single hand.
Just look at these crazy numbers. This stock's return on equity is a terrifying negative 71%. Its Piotrowski F-score, which measures financial health, is sitting at a bottom-of-the-barrel score of just 1. Yet somehow, analysts have set price targets suggesting a whopping 196% upside from its current $32 price. It's a wild financial disconnect. So how do we make sense of this without getting burned? Well, I'm going to give you a clear, actionable framework you can steal to safely evaluate pre-revenue biotechs exactly like this so you never get caught in a trap. All right, moving on to Section 2, the Atacicept FDA catalyst. So, the drug at the center of all this is called Atacicept. Now, this isn't just your run-of-the-mill generic treatment. It's an investigational fusion protein that specifically targets cytokines known as BAFF and APRIL. Why in the world does that matter? Well, because these specific cytokines promote B-cell survival and autoantibody production. Those are literally the root causes of a very serious autoimmune kidney disease called IgA nephropathy, or IgAN for short. The FDA has actually already granted it breakthrough therapy designation because it aims to be a best-in-class disease-modifying therapy for these patients. Okay, so the absolute crucial point here is the timeline. The FDA has granted priority review for Atacicept with a target action date of July 7th, 2026. Put a pin in that date because that is the main event. But wait, there's more. Vera recently aligned with the FDA to actually pull forward their Origin 3 trials EGFR analysis to the 3rd quarter of 2026, instead of waiting all the way until 2027. If those results come back positive, they are planning to submit a supplemental biologics license application in Q4 of 2026 for full outright approval. This massively fast-tracked timeline, that is exactly what the market is aggressively pricing in right now. Let's jump into Section 3, Zero Revenue, Massive Burn. Bringing a breakthrough drug to market carries a truly staggering cost. I mean, Vera's net loss widened dramatically, jumping from $152.1 million in 2024 to an absolutely eye-watering $299.6 million in 2025. That is a massive, massive burn rate. If you peek under the hood at their income statement, you'll see this is primarily driven by research and development expenses. Those spiked to over $215 million in 2025 alone as they aggressively push these clinical trials forward. Now, you might be wondering, if a company is burning almost $300 million a single year and bringing in zero revenue, how on earth are they surviving? Well, the answer is pretty simple. As of the 1st quarter of 2026, Vera is sitting on a staggering $596.8 million in combined cash and short-term investments. They successfully pulled off some massive equity financings, including raising over $300 million in late 2025 just to build out this massive war chest. Bottom line, this means they actually have the financial runway to fund operations straight through the potential FDA approval and even the U.S. commercial launch. All right, on to Section 4, the Buffett and Lynch test. Listen, if you try to apply traditional value metrics to a clinical stage biotech company, the alarms are going to scream, run away. Traditional metrics, they look for current profits, stable margins, steady, predictable growth. But the totally unique reality of clinical stage biotech is that the current value is almost entirely based on discounting future regulatory milestones and potential commercial sales. It's a totally different ballgame, and you have to adjust your lens completely. So let's see how it scores on our classic checklist. Zero revenue? Check. A deeply negative 15.9% earnings yield? Check. Zero dividends? Check. If we're going by Peter Lynch's gold standards for profitable growth or Warren Buffett's strict demand for high return on equity, Vera fails, and I mean it fails spectacularly. But here is the secret. It actually passes the absolute most crucial biotech survival test. It has incredibly strong liquidity. That near $600 million cash cushion means they don't need to dilute shareholders again before that super crucial July FDA decision. And in the biotech world, that is huge.
Which brings us to Section 5, Wall Street's surprising upside.
Despite the completely terrifying cash burn and literally zero current revenue, an overwhelming consensus of top analysts rate this stock a strong buy. Out of the 14 to 16 analysts currently covering the stock, the sentiment is almost entirely uniform. Why? Because they are laser-focused on the Phase 2b and Phase 3 clinical data for Atacicept. That data showed clinically meaningful reductions in proteinuria and stabilization of kidney function. Honestly, they're just betting heavily on a wildly successful launch.
I mean, just look at these specific numbers. The average price target is $68.31, but then you have Evercore ISI Group setting a target of $91 and H.C. Wainwright going all the way up to $110. When the current price is hovering right around $32, that shows some massive, deep-pocketed institutional confidence that the Atacicept clinical data package is going to clear the FDA's hurdles without a hitch. And finally, Section 6, the final valuation verdict.
Okay, here is that clear, actionable framework you can steal to evaluate any pre-revenue biotech safely. Step 1. Identify the FDA catalyst. For Vera, that's the July 7th, 2026 PDUFA date. Step 2. Calculate the cash runway. Vera has nearly $600 million, which is more than enough to cross that finish line. Step 3. Assess institutional holdings, which we are going to look at in just a second. And Step 4. Discount future revenue. You absolutely must weigh the probability of FDA approval against their current enterprise value of $1.8 billion. The key takeaway? Don't just gamble on the hype. Follow these steps every single time. Now, Step 3 of our framework is incredibly revealing here. Over 82% of Vera is held by institutions. Let that sink in. The smart money. We're talking about the massive funds with literal armies of PhDs reviewing every scrap of clinical trial data. They are actively participating in this high-stakes gamble. They aren't scared off by the negative ROE. They don't care about the zero revenue. They are positioned purely for the upcoming catalyst. So, the million-dollar question remains. Will the July FDA decision validate Wall Street's massive hype and actually turn that 200% upside into a reality? Or will that single regulatory hand fail, turning Vera into just another sad cautionary tale of biotech cash burn? Use the framework we just walked through, take a hard look at the clinical data, and decide for yourself if you're ready to take a seat at this high-stakes table.